Good afternoon, everyone. Thanks for joining. We just gave a few minutes to folks to trickle in here. Folks keep joining. Welcome, everyone. This is another open Ask Me Anything webinar session, AMA. We hold this about once a month, and it's a chance for everybody to ask questions. Our goal today is to get to as many questions as possible. So I'm going to hold myself to a one of those debate timers or something. I'm also getting the help of Richard, who is moderating as we go along, and I'm sure he'll prompt me when I'm taking too long to answer something. Generally, when I dwell on a question, it is something that is very common or something that I get a lot of requests for, and therefore elaborate. And the goal in elaborating and using as many analogies and examples as possible is to give as many people an aha moment as possible. So that's the goal. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. So let's start by looking at the questions so far. The questions have been cut off. You guys are going easy on me this time. I only have about 20 questions. So let's see if, let's make sure Richard's on board with us. Richard, are you there?
I am. Good afternoon.
Hey, thanks for helping out. All right, so let's get through. We're going to give priority to those who submitted their questions early. There was a form in the GoToWebinar sign up that was sent out, that was included for you to ask your question early. That form's been turned off about a half hour ago. And so we'll address these, and then we'll get to the questions being asked in the chat box in front of you. Mark B is asking, you talk about edge a lot and talk about how you exploit your edge with a particular trading method. Assuming a full understanding of the volume profile detail for the day and having a hypo in mind, how do you exploit your edge? What is your edge? Is it just a matter of leaning from particular levels or on particular levels over time, your risk reward such that you will make money? Can you show us to get a feel of how you trade? I'm still struggling to define mine. So the first step in answering this question is I'm going to refer you to a video that I did. It's a webinar that I did for Big Mike Trading or Futures IO that actually answers that in a fair amount of detail, and for the most part, that video is right here. So this video goes over basically from the beginning, from the plan to execution. This is what it's called. You might want to just note the, you can just go to YouTube, search for this title here, No Nonsense Approach, and Futures Trader 71, and you should be able to pull it up. And it covers that. And really the edge describes any probabilistic, a positive probabilistic outcome that is better than random, right? Better than random. So an edge could be information that you have before other people, or information that you have that other people don't, like the kind of, the kind of big edge has put people in jail, insider trading, things like that. Edge could also be just a simple probability of one thing happening over another, and you just are exploiting it with a reasonable risk-reward ratio. So edge describes a very, very big thing. It's like saying car. Let's talk about the automobile, and we could be talking about SUVs, minivans, race cars. It's a very gross description, but what it means is that based on the information that you have, you have an expectancy, a positive expectancy that things will unfold the way they have historically based on a statistical study or the way you're looking at the market. Boy, I'm getting a lot of alerts. So, you know, if I wanted to show you a simple edge, it could be, the last couple of days have been horrible, but it could be just as simple as something that I've talked about many times. The pullbacks on impulsive moves, a double IB. So these lines here, the yellow lines are the IB. Let me find an example. Here's a simple edge right here. Doesn't always show up, but when it does, it's really good. So let me get my drawing tool. I could be better prepared, but the day has just flown by. Okay, so here's the IB right here. In fact, let me use a different color because I'm going to confuse you.
And just before you go, the IB is the initial balance, which is set as the high and low after the first hour.
Good point. And also while I'm here, I want to point out that you can always have this page open. You can go to my website and you can just go to the glossary and you can scroll down to find what that is. Here's an example of an IB. You expand it. It gives you an image to show you what the IB is and so on and so forth. So you know, if you're new to all of this stuff, you have the resources to understand what the terminology is. But on this particular day here, I'm going to draw in black. Let's make it white. We have the initial IB, the initial balance here. The first hour is low. Here's the first hour's high. From this point forward, these lines stay steady once 9:30 happens, which is about right there. These lines do not move for the day. The edge here is that the market tested higher, so this is a contextual edge. The market has tested higher and has had an impulsive move down. It has had a continuation move and a second continuation move for a rotation back to mid, Vwap, IB low, and low volume node, which is a volume profile based edge, right? All of these come together right here at 46 even. The price is 46 even, right on the dot. What does the market do? It goes to 46 and a quarter. Back in range, back in value, has already tagged the point of control and has pulled back. This trade here has a very high edge, a high probability of playing out. Now what it could have done is it could have pulled back, chopped around, and pushed right through back into the range outside of the prior day's range and exploring, and chances are it would go neutral in that situation. But something as simple and as visual or contextual as this is an edge right there. Okay, but there are also statistical edges. The overnight stat is an edge. The IB stat, you know, the IB stat is there's a 3% probability that the day would end with both of these lines intact. In other words, both of these lines not breached. They have to be breached by one tick at least for this probability to play out. So 3% of 2,000 days look back. 3% of the time, the market will not breach the first hour's high or low on a normal day. 3%. So the inverse of that is 97% of the time, the market will likely break the IB high or the IB low. Great. That's a high probability, but how do you use it? The way I use it is, again, I'm a contextual trader. I'm using volume profiling, and I'm also using price action. The way I use it is to look at, once the IB is in and if the market's in the middle, which side is likely to give way? What has it done so far that would lead me to believe that the IB high is going to break rather than the IB low? In this situation here, nothing tells me that the IB low is more likely to break, so I can go for the 97% probability by hitting the bid and getting short into it and getting out a tick or two ahead of that IB low just to guarantee a fill. There's nothing that says that until the market does this, until it breaches not only back into the prior day's range, but it reaches the mid, and not only that, but it actually pulls back to what I call a zipper. This is a zipper right here. So I'm giving you all the secret sauce here, right? This is a consolidation zipper right here. The market does these all the time. Once it makes a move, it makes a little zipper, little zipper. They're everywhere, okay? So because the market in its process of auctioning, it's made up of humans. It's executed by machines, so people argue that it's algorithmic, but not necessarily. It's very human in nature in that it sprints, then it takes a breather. Then it sprints, then it takes a breather. And we call that balance, imbalance, balance, imbalance. And we recognize that whenever there's balance, there's as time goes by and as volume accumulates at that balance point, there's a higher and higher and higher probability of the market breaking in one direction or another. The more volume that goes into a zipper, the bigger the break that follows, because the more volume that went into a zipper, the more consolidation there is, the more people are committing, more participants or more contracts are being committed, long or short, and those are the contracts that are more likely to fuel the move away from here. So the key trigger is right here, though. So not only did it break the mid back into the range, this is the prior day's range high, so you can see the prior day's high is 51, but it broke through, and then what does it do? It comes right back to the zipper. And we can see, actually, if I wanted to, and I often do, I can see where in the zipper the volume is. And there's the volume point in the zipper right here at 51 1/4. And so getting the short, taking the short through 52 1/4 or so is okay. I would not want it. Yeah.
Can I just stop you for a second?
Yeah.
Just a couple of things. One, when Murad talks about the mid, it's simply the 50% between the highest and lowest at a given point. The second thing is when he just threw on that big black line, that's the volume POC. It's the area where the most volume has traded during that time.
Mm-hmm. Yeah, so I'm used to having these AMAs for stage 5s traders, and they hear this stuff enough that I don't need to break it out. So I appreciate you interrupting and explaining that, because I'm probably losing people as I'm flying through this. But that's the point here exactly. I'm looking for where's the highest volume cluster within that zipper, and that becomes literally my point of control for this trade. So I'm looking for this market to pull back to the zipper. It triggers the short somewhere in here. The short actually triggers a little bit lower. I need to see it happen first. So it triggers on the fall, and then it's looking for an exit a couple ticks ahead of the IB at 46, 46.50 or so. You can see the first bounce here at 46 1/4, back to 48 1/4 for 2 points, and then it follows through. And if we have an impulsive move down, then we're expecting a continuation move. If we get another impulsive move down, then we expect a continuation move for that. Not always, but it's the general nature of the market. That's edge. So that's a different type of edge. So there, we're playing a statistical and a contextual edge. There's also a news edge. The news that came out with Russia and Saudi Arabia being in discussions on Tuesday and all that stuff. If you had a news feed that provided that information to you before the market started moving, that was a huge edge. You had a couple seconds at least on my news feed to hop on that trade. That's an informational edge, and so on and so forth. But I think that addresses the question. So it's not one thing. It's not an easy thing to describe, because it's many different things that occur at the same time. But it could be a unique indicator-based edge and that edge is all you trade, and therefore you're trading a systematic type of edge. And that's also an edge as well. So when I talk about edge, I'm talking about it in general, not in a specific, here's the exact edge type of thing. And by the way, great question, Mark. It's really important for everyone listening, supremely important, in fact, to understand that you have to own this. You cannot take what I'm doing and expect to go do it and make money. You can't. I have backed people. I have traded, I've been a prop guy. I've been a prop owner, and in all of those conditions, it's practically impossible for someone to come in and just take someone else's idea and just immediately make money. So I'm telling you that up front because I want to make sure your expectations for how your trading and your progress are realistic. There's a tremendous amount of risk that we take when we're doing this, and if we don't pay a healthy respect to it, then that's also a cause of ruin in my experience. But overall, whatever that edge is, whatever you're doing, it has to be yours. It has to be something that you've looked at. You can gather ideas from myself, from books, from forums, from Twitter, from your buddies, from your Skype group, whatever it is. But ultimately, you have to put the ingredients together to make your own soup, right? And so, and you're the one consuming that soup ultimately, so it needs to match your taste. And the only thing you cannot skimp on is how much capital, risk capital you're trading with, and how you're managing your risk. Those things cannot be tampered with. Risk is really not something that is fashionable to talk about. It is real. Ralph, I would like to test my reading of the market. What's the best way to backtest profile trading? Does S5 Trader allow for full playback on multiple charts at the same time to mimic real time? So Ralph, I've got a good and bad news for you. The S5 Trader, the platform that I use, allows you to record everything that you are looking at. So if you're pulling quotes across multiple products, it'll have you record all of them so that when you play it back, it is replaying the market, all the markets that you're looking at. But it's not able to handle volume profiling. There isn't an indicator that's been written to it, although someone can. It's kind of like TradeStation, but it does not have the volume profile built into it. I use Aight RT for this. It's a product by Linsoft, and what you can do is actually play back. You can play back the tick data. There's a playback facility here. Right there, you can tell it the date, you can tell it the product, you can have it replay all of your products or whatever, and it'll go back and it'll replay bar by bar, and you can pause it and fast forward and stuff. But the S5 Trader alone cannot do it with market profile or volume profile. Darren, so let's hide these as we take care of them. Darren, could you walk us through an example of pullback to mid? Darren, I think I might have answered your question already with the example. Don't you think, Richard? I think that pretty much addresses it, right?
Yes, I do. Maybe there's one thing you could add here is some people have asked, you also mentioned Vwap when you mentioned mid, and they were wondering what emphasis you put on the Vwap in your trading. Okay,
so Vwap is not only does it sound like something cool, but it's an important measure for desks, for institutions. Vwap is a volume-weighted average price. The system essentially, it's a mathematical formula. The system is essentially averaging out the price, averaging out the volume by price. So it's taking how much volume traded at each price, and it's summing those, then it's dividing it out to give you a price that reflects everything from whenever that Vwap price started or the Vwap indicator started to where you are now. The way I use it is I look at VWAP like a speed bump. I treat it like a speed bump. It is more of something that backs you up. It's more of something that slows the market down than it is something that I consider to be an obstacle or something that changes context. For example, when the market drops below VWAP on any given day, that doesn't necessarily make me bearish. I don't use it as a moving average, let's say. But I do scale out in front of it. So let's say I'm long here and there's nothing else but VWAP. I'll likely scale before that VWAP, and if it pulls back and starts to push through VWAP and pulls back to it, I'll add back on, or I'll do my best to continue to ride the next wave. But VWAP alone is not an indicator by itself. But I know that the performance of trade desks and institutions is measured by VWAP. So if I'm a buyer, if I tell a desk, hey, buy me, I need to buy 8,000 ES, June ESs, and you're working my trade and I see that you bought them below VWAP for the day, then I know I'm getting a good fill. I know I'm getting a decent performance for my broker. But if I see that VWAP is 6 points below, and I gave you the order before the market, and here you are at the end of the day, you filled me, and you filled me, 6 points above VWAP, I know that you either filled my book too late, waited too long, and filled, gave preferential treatment to someone else, or you just have a terrible trade desk. Because you should have been able to execute at or below VWAP for me for the day, unless you sat on that trade, which is not your job to do that. Okay, so that's what VWAP is. So Darren, just you'll get the video for this. The video's going to be posted, and it'll be available for as long as YouTube lets it be available. So you can go back, scroll back to when I was answering Mark's question. And that's basically the answer to your question. The biggest thing I want to highlight here, what mistakes to avoid. You cannot blindly take a trade at the mid. So trading the mid does not make contextual sense if the day is in an open auction. If the day's in an open auction, then what happens is what you saw yesterday. And what you saw yesterday is the market is in an open auction here, zigzagging back and forth. The OS yesterday was 66.75 to 65. If we know that the market's got two-way trading, then the market is likely to run through the mid. Again, the mid is this blue line, and the formula for the mid is the high of the day plus the low of the day divided by 2. That's the mid. So every time we expand our range, the mid changes. It changes. So it changed with this move. It changed with that move. What you don't want to do is trade the mid when you know you have an open auction. The better opportunities to trade the mid are when you have an impulsive move away. So let's take what has happened here. What has happened here is the market has open auction out of range. It has broken the auction higher. It has confirmed the opening swing high, has pulled back to the mid and VWAP right here, created a small opportunity, and it has failed through. And this failure here is impulsive. So this trade right here, you see the zipper right here, this is a legitimate mid trade with the caveat or the lower probability of it being an open auction that has caused this. And so this trade is expected to pull back to around mid and then continue moving down. And that would have been hypo 1 or 2 yesterday. That's an expectation there. But it's happening after an impulse in an open auction. That's okay. Same here. This is an impulse move to the other side. We have range extension to the other side. The day has gone neutral. You see how it's chopping around the mid here? This is a common thing. and this is another failure here. These kinds of days, just like yesterday and today, are not my kinds of days because my edge is not relevant in these days. It's not the type of day where it's easy for me to pull money out of the market. But I counteract that possibility because I scale out a trade. I don't know if this is going to happen. So the tendency is to get in and look to scale out, usually 8 ticks or so, 6 to 8 ticks, to mitigate the cost, and then see how the market plays out. If I can, I'll add on. If I can, I'll add on. If I can, I'll add on, and so on and so forth. But the case of the mid, it's not a blanket statement. Wherever there's a mid, get long or short. You probably lose money, and it's not my fault. Be warned, in other words. Andy B asking, what is the easiest or fastest way to determine if a day is going to be a trend? Trend days are awesome if you're in it, but very hard to trade. So the probability in the ES, and it varies slightly in the NQ and other products, the probability of a trend day, a legit trend day, and I define trend day in a more market profile-ish perspective rather than higher highs, higher lows all day. The probability of that is somewhere around 18% of the time. 18% of the time of the days are trend days. That number can vary. It was higher in January and February versus it's back to where it is now, and sometimes it could drop, like choppy summers. It could drop to 15 or so. But in general, trend days are not the lion's share of what the market can do. They create these big opportunities or big perceived opportunities because folks want to just get in and ride the wave to, new all-time highs at 2100 in ES from 2040. That's what everybody wants to do, right? But I can tell you that there's a lot more opportunity in days where intermediate term traders are in control and the market is swinging from one side to the other, as opposed to just a grinding day. I'm not the person to ask this question on how to get in on a trend day, but I do look for several things that might indicate a trend day, and that is the opening location, the opening type, how the market has traded in the first hour until the IB is in, how the IB is breached. Are we moving into new territory, or are we just cycling within balance? Like yesterday, this trend is to be expected. Yesterday broke out of a 6 trading session balance or 7 trading session balance and was unable to fill the gap in the first hour. There's a high probability that if the market turns the other way, extends the range up, there's a high probability that you would end up with a trend day. That's another indication. Trend days also tend to bring in high volume early. After the first 15, 20 minutes or so, you'll start to see that the relative volume is fairly high. So you'd get these bars that are much, much higher in volume than the 20-day average. The 20-day average is described by these yellow bars. For each time slot, there's a 20-day average, and we look at the volume for that time slot, in this case, a 15-minute time slot, because it's a 15-minute chart. But those are some of the indications, but I'm not an expert on trend days, I'll tell you that. They're just not they're not fun days for me to trade. And if they become something that occurs 70 or 80% of the time, they'll get my attention. But at 15 to 20%, let's say, just for averages, it's not worth it's not worth me focusing a lot of effort looking for a trend day when I know that most days are generally reverting to balance or at least testing balance. Ralph. Being new to profile, I'm trading references, overnight high, low, midpoints, yesterday's high, low, LVNs. This works right now as the market's being traded by day traders. Please take us through an example of trading price rejection and acceptance when the OTFs are moving the market more aggressively and therefore don't care about the day trader preferences. So those levels are day type levels. They're actually short-term to intermediate term levels. This is when I say in the trader bites in the morning, I say, hey, listen, watch what happens in the open. Just sit still and wait for the market to set its course. This is one of the things we're looking for. How is it treating the prior day's range, prior day's balance? How's it treating the overnight high? And so on and so forth. What kind of a profile is it forming early on? And then in general, when the OTF steps in, you know it. So here's that news day. This is an OTF move. Up to that point, the market is fairly balanced, so it's whipping around, right? So it's testing prior day's high. It's tested the prior day's value low right here. This is the value low. Prior day's low, I meant. But then when OTF comes in, it just pushes right through. It doesn't care what's in the way. It pushes right through, and it continues to push right through. OTF being other time frame traders. And so when higher time frame trader, and I suggest to get more detail on this, just look at webinar 3 on my website. I don't want to regurgitate what's there. When a higher time frame steps in, it is the third force in size, and generally a higher time frame does not care. The highest time frame does not care that there's a weekly high or the prior day's high, or that we're breaking out of an inside day or whatever. It doesn't matter. These guys, if you've ever been at an institution and looked at how a trade desk operates, they operate in large volumes. They're looking at filling 100, 200,000 contracts, or rolling that much, or putting on a hedge for that much. And a 20 or 30 point range is not an issue. It's factored into their cost to have to interact in that big a range. So they don't care about yesterday's high or whatever. It doesn't matter to them. So I can't pull up specific examples. It would really slow us down. So I'll keep moving. But good question nonetheless. Naveed asks, I have finally come up with a great trading plan to execute trades. I'm an intraday trader. After 2 years of struggling, I'm building up my account. After 2 strong months, I find myself getting cocky and taking trades that do not fall into my trade plan. How can I stay on course and not stray from a solid plan that I have? I know exactly what I did wrong on those losing trades. Loaded question, but I'm sure you've been there. And this question, or a similar type of question, gets asked on every AMA. It's a very common problem. You're not alone. But here's the thing. It's your risk profile changes. Everybody's risk profile, just like our personalities or our state of consciousness, changes all the time depending on who we confront or who confronts us. For example, if I ask you in your normal day-to-day life and in a calm environment, if I ask you if you would ever kill someone, your answer will be, that's a terrible thing. That's a crime against humanity. I would never do that. That's a stupid question. But given the right circumstances, you will. You would. The same thing that's a very strong analogy just to make the point, but the same thing happens in trading, where you could sit there and come up with a plan and create a risk plan and create these parameters and do this beautiful thing, right? And organize it and laminate it and all that stuff. But given the right circumstances, your risk personality will change. And your only defense against that is to be aware of it. Just be aware. It's kind of like someone who's an alcoholic who doesn't want to drink. Can we rid the world of all alcohol? Can we start the prohibition again? the only defense they have is to admit that they have this issue. Hello, my name is Naveed and I'm an alcoholic, right? Not saying that you are, but to also start to put steps and things in place, a plan in place that allows you an outlet once the process, the cue, if you read The Power of Habit, is a good book to read about this. The cue, we want to recognize the cue, because after the cue comes the routine. After the routine comes the reward, and you're looking for that reward. And the reward is, I got to make more money. But it's a deceptive thing in trading in that you become risk-seeking because you've got it figured out. Hey, you've got some house money. You did good, and you can always go back and follow your plan. So why not take these extra trades? Because I'm getting a lot of dopamine from all those good trades that I took and all the money that I made. So I need to get more dopamine, and the only way I can get more dopamine is to take more trades and make more money. This isn't your little drug dealer, the market. It isn't. It is business. It's strictly business. You're either in alignment with it or you're going to get crushed. And so how do you stop that? You stop that by knowing that you are going from being a trader who's looking to be a professional, you've been doing this for 2 years, to being a gambler. And if you choose to be a gambler, then it's okay. That's fine, except that you're risking all the money in your account because you're suddenly allowing emotion to come into play. It is your emotions. You're seeking an emotional high by switching away from your trading plan. And you will not likely last in this business. And there are many, many like you that have come and gone. So the question is, do you want to be in the group that has come and gone, or do you want to be in a group that sustainably stays here and does this for the next 15, 20, 30 years, however long it takes you to reach your goals? And if you want to be here for a while, sit back, chain yourself to your seat. It is a grind. It is not, don't try to get an emotional high, or don't try to beat boredom by trading outside of your plan. If the market's not showing you your edge, as it hasn't for me much in the last couple of days, there's just nothing to do. There's just nothing to do. There isn't. It's a lot like, being someone who flips merchandise on eBay, but doesn't seem like there's anything you can flip. You don't just suddenly go to sell something that you don't understand, the market for which you don't know. You just wait. And so become aware of when you're starting to go away from your plan, and that's a great time for you to just get up and refill your glass of water, get more coffee, go for a walk, whatever. But the answer, the secret to beating this is in the awareness. It is that moment when you are about to violate your diet plan by reaching into the cabinet with the brownies at Whole Foods or whatever. That's the moment where you have to make a conscious decision that I will continue with this process. You want to pick up that brownie or piece of cake, put it in a box, and then change your mind as you're walking to the register and put it back. That's great. You want to eat it, enjoy it, but you're going to have to come back the next day and start all over again. Okay? So it's that moment that is be able to be aware, and that's what makes good traders from an emotional perspective. And I'm not a psychologist. It is the habits you form, the repetition and routine, and part of that is your ability to recognize your emotional triggers. This is a really important part. A good trader, like when I switched from equities to futures, there was a guy who used to trade the Euro stocks overnight. I won't mention his name. And I used to come in, and he would be there during, here in Chicago, and he would be at the prop shop, and he would be there early. And by the time I show up, he was up, 2,000-3,000, down 1,000-2,000 on any given day. You never heard a peep from that guy. He was just ice cold, you know, and he came in and he just churned and churned every day, and he just did his part, and he was gone by the time the European session was closed, which was 10:30 our time, and that's it. There was nothing more to it for him. It's just, I'm coming here, I'm coming to compete, I'm coming to work, and that's it. But if you find yourself talking about your trades, boasting about your trades, celebrating your trades, needing to have feedback on your trades, things like that, just be aware that those are emotional triggers. Those are things that are, those are emotional needs that you're fulfilling with trading, and trading is, it's like, you know, it's probably like a drug or something. It's a seductress, you know, it makes it seem like the right venue to do that, but it's not. It can be pretty detrimental to your financial and emotional life and social life. Celine, Sundays during your Trader Bites, you tell us to wait about 30 minutes until we figure out who's committing to what in terms of buyers versus sellers and price direction, and then make our trades based on that. What are some signs with price action that can help us figure out which side buyers and sellers are in control? So I covered that a little bit. If we look at today, today was one of those days where I said just sit still, wait, and see what happens. Today we had an open auction, it looked like, but it turned into an open rejection. And so what we want to see essentially is, first of all, where does it open, and how does it perform its test? So early on, it tested the prior day's high, and it fell right back through. It just opened, tested the prior day's high, and fell back through, and it had a follow through. So at this point, what I'm reading is, okay, our opening swing is the first indicator. Our opening swing, the quality of that opening swing. Let's actually pull up the trigger chart. So if you look at this, I'm paying attention to where the open is. It's this dotted line right here. What does it test early on? What happens on that test? Here's a rotation 3.75, not a huge rotation, but pretty decent. What occurs after that? Does it pull back, high or low, and starts pushing out of the range? Again, the range is, prior day's range is really important. So the question I'm looking to answer is, who's playing here? Is it folks who feel that these prices are too high and are becoming responsive? In other words, they're looking for prices that are too high and will sell any pushes up, expecting the market to move down to the point of control down here at 68.50? Or are there people looking at this and saying, man, these stocks are really cheap. I'm going to buy any dip, and then we're looking for it to drop and then a huge rotation up. So these rotations, these pesky numbers that you see on here, they seem like they're just clutter. Those are rotations. Those are telling me how far from the last peak to the last low, how far from the last low to the last peak. So you can see this rotation here expanded up versus the rotation down. Buyers are in control. So at this point, we're outside of the prior day's range. I'm looking for any pullback to the prior day's range, looking for an area to stock long. If not, I'm looking to stock long again at mid, and then I'm expecting this little move here to get its continuation, which it did up here. So that's what I mean. It's hard for me to describe all these things in an example like that, but on the fly. But you're looking for which way is the delta going. Here's let's pull up delta here. Which way is the delta going? How's the delta responding? Is it in this down rotation, did it respond very aggressively versus the up rotation here? From there to there. Are they hitting the bid strong or lifting the offer strong? These are all little things, but if I was to list them, they would be the opening location, the initial test up and down, which encompasses not only what it tested, but the opening swing, how is the delta responding on the open, what is volume like on the open, what are the rotations like in the first half hour or so. Are the down rotations mostly dominant? In other words, you can have up rotations that go higher than, so let's say this is a big down rotation here of about 4 points, 4.5 points, okay? You can have little up rotations, very little up rotations that take back that entire 4.5 points. But then as it reaches higher, you'd have one big down rotation. It's telling me that there's a seller here in play, and I'm looking to the delta to see how's the delta responding. If the market continues to push higher and the delta continues to push lower, especially during the active time before 10:30 Central, then that could be an indication. But I'm looking for little clues, not something with a high probability, but a whole bunch of little clues. And no, I don't use the footprint. I don't. I tried it a long time ago. It's not something that's in my arsenal. It doesn't mean that you can't use it. It's just not something that I use.
FT, just before you move, somebody was asking you. You've mentioned a few times about hitting the bid and lifting the offer, and if you could just briefly explain what you mean by that.
Okay, so let's look at this. So this is my Bookmap chart. So this is your dome here. This is the same as a price ladder. I could pull up my trading platform here, but I won't do that. It'll take too long. But this is a price ladder here. These are the offers. These are the bids. The bids are what's underneath. The bids are liquidity that's underneath, or orders that are underneath the market. So right now in the S&P you have a bid for 194, a bid for 900, 800, a bid for 610, and they're represented here on Bookmap as one single column, and they're drawn graphically. So don't let that confuse you. It's the same thing you have on your price ladder, okay, if you're getting a full price ladder. Hitting the bid is simple. It's a trading term. Hitting the bid means you crossed the market. In other words, you want to sell aggressively enough to move from offering at the best offer, which currently is 20.77 1/4, to actually hitting the bid, the best bid, which is at 20.77, and there's about 500 there right now. That's what you're doing. So somebody just hit the bid here. You see how this move shifted down? Somebody has hit the bid. So they're selling across the market. Every time you hit the bid, you're subtracting from delta. So if the delta is 0 when the market opens and somebody sells at the bid or hits the bid for one contract, your delta is -1. If somebody buys one at the offer, and the offer is the best offer right here, which is currently at, looks like 20.7675 for 400. Somebody lifts a one lot, the delta goes to 0. If somebody hits the bid for 10, it goes to -10. Somebody lifts the offer for 20, it goes to +10, and so on and so forth. People hitting the bid are the aggressors. Okay, so yes, these are they're not necessarily market orders. They could be limit orders that cross the market. A market order technically will take whatever the best price is. So if the market has a huge gap, it'll go several prices up. I don't use market orders. I use limit orders even when I cross the market. That way, I'm not getting executed at more or less than the price that I requested. That's what hitting the bid or lifting the offer is, and that's how the delta is built. It's just basically a summation of how many contracts have hit the bid or sold at the market versus lifting the offer or buying at the market. Okay, that's the summation. It tells us, it gives us a clue as to the aggressor. And the catch with the delta is the time of day, because the time of day dictates how much the delta rules price versus price ruling delta. I won't get into that right now. I'll confuse the heck out of you. Does that answer the question, Richard?
Yes, it's perfect. And just one clarification. You said you only use limit orders, but your stop orders are market orders. Is that correct?
Stop orders are market orders. Yeah, if you use a stop limit order, especially on a thin product like NQ, Russell, crude oil, gold, what could happen is the market could actually trade through your stop, and you won't get filled. So if I use a hard stop in the market, it's a market stop.
Yes. Okay.
Next question. We're about halfway there, and we are almost through an hour. What is enough bare minimum to take a trade for you? For example, trading during the last hour of RTH when most stats are out. What is enough bare minimum to take a trade for you? Do you understand that question, Richard? Not sure if I'm catching the question here. What is the bare minimum to take a trade?
I would only be guessing. Okay. I think maybe best is to be re-asked the next time.
Yeah, if you're saying what is the minimum I need to see or the minimum requirement now that all the stats are done, if it's a legitimate trade as opposed to a scalp, because I do both, it's got to have it's the same thing. I've got to have, maybe there aren't statistics left on the session, but I've got to have some sort of a context. If I'm not trading with any context and I'm not scalping, then I am being a fool. And that happens, but it's very rare. Valdemar, I've been day trading European index futures for over a year now without too much success. Well, I've blown up my account. Okay, so that's experience. I've spent months doing statistics but can't find an edge. Now I'm back to fluid discretionary trading again. Sometimes I'm very pleased with myself and profits only to give it back the next day. But then I think maybe it has nothing to do with me. Maybe it was just bad luck, coincidence, randomness of the market, which I cannot control anyway. I've made dozens of observations that may translate to trading rules only to find out the next day these rules don't apply. How can I be disciplined if I don't know what to be disciplined about? So this is just a huge question. This is almost like a seminar type question. There is an edge. So if you're trading the Euro stocks, the FTSE CAC 40, DAX, whatever, I hope you're not trading the DAX, first of all. Very difficult to find an edge there for a beginner and a very, very expensive product to learn on. But if you're trading, for example, the Euro stocks or the FTSE, of course there's an edge. It's the same thing that there is in the ES. You know, for risk, adjusted for risk, there are habits to every market that repeat and repeat and repeat. But if you're statistical testing, so you say you've searched and you've had no success, I don't know what you've searched, and I can't look at it, but there are habits to those markets. If I pull up a Euro stocks chart, it's the same thing. It puts in an initial balance, although we use 2 hours for that product. It has certain tendencies. You know, just look at something as simple as when it opens out of range, how often does it touch the prior day's high? How often does it touch the prior day's value? You know, I strongly suggest you take a look at the free videos on my website, especially the earlier ones from November, 2009 or 2008 or something, and look at those. In one of those, the first one I did, I show a spreadsheet and how we do a simple review. You might want to just look at that. But there is an edge. And if you're trading discretionarily and you think it's bad luck, yes, the market can be generous to your plan today and not so generous tomorrow. The market might give you opportunity today and not give you opportunity tomorrow. That's true. But if you're discretionary trading, which is a lot of times synonymous with gut trading or trading on feeling, I personally, in my own experience, I believe it has no long-term edge. So if you're an order flow trader, you're using, you know, Bookmap or whatever, and you're creating tendencies, I get that. My entire prop shop was built on high frequency, high volume scalpers that are just looking at the dome and are not looking at charts. They had charts, expensive ones, they never used them. And they did fine because they're trading the flow of the market, and that's okay. But if you're trading discretionary as an online person, and you don't have some sort of a plan, and especially if you don't have some risk controls in that environment, the risk of ruin there is extremely high, and I would suggest you just stop trading and come up with a plan. There is a plan for your markets, for sure. I don't know what it is, but it just depends on how much you have in your account and so on. If you'd like, consider joining Stage 5 and getting into the chat room and following the discussion and seeing what statistics are being discussed and if they're applicable to your markets. There's a Eurex room in there. Chris, please elaborate on how you set up volume profile and why exactly like that. So volume profile is just an evolution of market profile. We take volume at price and we put it on a vertical scale, and it shows us how much traded at each price level. It's irrelevant of time. So this volume profile will look exactly the same for a 60-minute today as it does for a one-tick chart. And the reason I use it is because I could consider myself a pretty advanced or expert level market profile user, like this stuff here. Classic market profiling with the letters and stuff. And I was using that for a long time before I figured out that I have tick data. I was paying for tick data and I could chart volume instead of 30-minute time slots. So I switched to volume. And when I switched to volume and did all these tests, tons and tons and tons of tests, I observed that there are certain habits that the market has at low volume nodes versus high volume nodes. This is a high volume node right here. This is a high volume node right here, which is also the point of control. This is a high volume node. So yeah, the market kind of transitions these. In the future, there's probably going to be a high volume node, and someday ahead from now, there's likely to be a fairly high volume node here. There's just certain habits that repeat themselves. So that's as detailed as I can get with your question because it's not very specific, but again, just look on the website at the videos. You should be able to glean some stuff from there. Josh, do you think it's possible to be able to achieve a success as a trader while maintaining a full-time job? I have the ability to monitor markets and make trades via the mobile app, but both are often limited as a result of regular commitments. If so, what would you recommend for strategy and execution? So, it's not my field, so I don't want to. I cannot comment on whether you can achieve success while having a full-time job. It's not something I've ever done, so I'm the wrong person to ask about that. I would be speaking out of turn. But if I put myself in your position and I had to maintain a full-time job while I traded, what I would do is actually look at, first of all, you have to have a lot more money to swing futures or even stocks. Well, not necessarily stocks, but definitely futures. The drawdowns can be fairly substantial. But in my opinion, I would start looking at weekly options. Working, trading weekly options or spreads. That's where I would go because then I can reduce my margin, I can define my risk, and I can just turn off the platform. You can do that on your S5 mobile like you're doing, but just with the options, just determine the strikes, and the way I would do it is to use volume profiling. The strikes that would be of interest, for example, would be LVNs in the short term. Like the big one that I would be looking at is down here. The big cutoff point, which is 2026, is one. 2015, 2015 is a huge strike I'd be looking at. You know, the point of control is at 40.50. The market's attracted to that strike, so you can play a butterfly or something around that price, with the expectation that a certain amount of time the market will likely revert back to that price, which it will likely do that. Things like that. That's what I would do. I would play longer term with option spreads. You can reduce your minimize your cost and risk and margin, and you don't need to watch them because your risk is predefined. I don't think I would trade futures on a swing basis part-time. And I don't know what job you're doing, but I tell you what, if I have a trade on and I have a mobile platform, I'm not getting my job done while the market's open. It's just not going to happen. So it's probably, you're neither here nor there. I would probably shift to something a little more long-term, is what I would recommend. Anthony, is there any guidance you can give us on how to factor in the MC, microcomposite? A microcomposite is a profile that is generated by combining multiple days. So if you look at today, if today returns and closes inside of here, and essentially the auction moves back in here, tomorrow morning I'll create a brand new microcomposite. So instead of looking at the individual profiles that you're seeing here, I would be looking, in addition to that, at a 2-day profile, because I would want to see combining these 2 days because they traded within each other. So the key item with microcomposites, or how we create them, is when you're when your goal is to see what multiple days look like, when combined together, and that's what a microcomposite is. So as today drops through and starts pushing down, you see how this point of control is inside of the prior day's range. It'll definitely be much more imbalanced if this point of control starts moving into the prior day's value, which it could still do into the close if it starts to push down. And then we look at the microcomposite, and we can see from the microcomposite already that we have a key distribution down here, and we have a key distribution up there, and what we have up here is basically rejection. The expectation for the rest of the session now is that the market is not likely to revisit these prices up here. I expect this to fail through the mid, which it has, and I expect it to continue lower. There's a pretty decent chance that we get neutral by breaking the IB low now. So the microcomposite tells me where those big volume areas are, and that's what describes to me that what prices the market has accepted. Okay, so that's that. Dan, this is a sad question. Oh man. I've been trading the ES futures for years, real money and sim. I've blown through quite a few accounts. I really feel that trading futures is for me. I love the market. I watch the market every day, although I'm at work. So I've been listening to you for years. I've tried many trading rooms over the years. I've realized over the years that volume profile is a valid way the market moves. My question is, I've been able to be profitable for a few months on sim. How would you suggest I get started on another account? I have kids and have absolutely no way to accumulate money. In fact, just the opposite. I'd love to use stage 5 and all the tools, but it seems like the monthly charges would just be prohibitive on startup. So any suggestions for someone who really believes himself but cannot think of a way to get in the game? Dan, I don't know what the monthly charges are that you're speaking of. First of all, there are, when we created the plan for stage 5 trading, the idea is to bring together committed traders. If you're a committed trader and you're looking for other committed traders and you're looking for professional level tools as best as we can, this is what stage 5 was built for. There are no monthly charges. The only monthly charges you can incur are from the exchange for data feeds or from your software. But stage 5 itself does not collect any monthly or charge monthly charges. We've got a lot of people who open an account with us and simulate for a long time, work through their issues, work with a trade analyzer and so forth to localize their problems and so on. And that's okay. We don't pressure anyone into trading. We're just not fans of opening an account, taking advantage of all those proprietary tools, which most of them come from my prop shop, and then go trade somewhere else because we only get paid when people trade. But I would strongly suggest that you look at the capital that you put into futures as money that is at risk. We call it risk capital. This is money that you can stand to lose without affecting your retirement horizon or your lifestyle. If you have kids and you cannot commit enough money, and that's one of the key problems with traders who are struggling, is being undercapitalized. If you cannot commit enough money to allow yourself a decent chance, I as a trader to a trader and as a father to a father, I cannot in good conscience tell you, yeah, come over, open an account, simulate with us. I would say stick with your simulator, get better tools. If you're in the US or Europe, as long as you're not in Canada, you can be on the S5 Trader, and as long as your account's funded, you can simulate and get the tools and all that stuff. But you have to be well funded before you trade. And if it's money you're taking out of your college fund or whatever for your kids, then I strongly, I would not want to open your account. I would want you to just take your time and go do something else, accumulate, maybe wait for a better financial situation before you trade. The last thing you want to do is go trade money that you cannot afford to lose, or money that you have earmarked to pay rent or your home. It's just wrong. But if you do have an account now and you're simulating and so forth, I invite you to join Stage 5. And I'm not trying to plug a brokerage here. I believe in what we're doing, and I think most of our traders who are part of Stage 5 believe in what we're doing. I mean, we're really pushing to disrupt the way the industry handles trading and traders. So with that being said, if you're making money over a short period of time on sim, it is not enough to go live. What you need to do is look at your expectancy and expect that to drop live. You have to look at what is the cause of your blow-ups in the past. What is the cause of your losses? Are you just someone who gets angry? Are you someone who doesn't like to lose? Do you like to fight? Do you like to argue? Ask your significant other, your wife or whatever, how do you handle conflict? What kind of a person are you when it comes to things not going your way? That helps identify where the issues are. And then, if you want to work on those issues, we have weekly AMAs, and we have all these things where you can, if you have the courage, you can come out and ask the question and be on the spotlight, and let's figure out what the issues are. We don't offer one-on-one mentoring. I can't look at your results. It's just there's no capacity to do that. I'm just one person doing this trader development. But I just caution you not to trade futures or anything if there's financial pressure, or if the money is not something you can stand to lose without affecting your lifestyle or retirement horizon. Just don't do it. The market will be here a long time. It's been here for thousands of years, and it will continue to evolve. So get your affairs in order. You do not want to start trading while feeling financial pressure. It's just not a good spot to be in. Okay, I'm giving you the best advice I can give you. Take it or leave it or whatever. But I would not trade while being in distress or feeling like you're in distress. Danny, I won't be able to attend in real time. However, here's my question. I'm interested to know how you use Delta and how much emphasis you give it to its readings. I've noticed that the past 2 days in ES, price continued to make higher highs while Delta made lower highs, even dipping way into negative territory while price was well above the open. But even as this happens, the market continues to auction higher against the divergence. Just wondering how much it influences your decisions. So I talked about that a little bit earlier, The delta overall I don't see it as having moved down or in divergence with price. So let's resize these panes. So when we look at the delta here, it's pretty much in line with the market. You know, you have to compare it to where it opened, but you know, it's making peak for peak, trough for trough. Yes, this is a lower high here, or lower low than it was on price, but look at the time of day. The time of day really influences how the delta behaves, because a lot of people just stop trading when the European markets close until the last hour, and then it picks up and it gets back in line. Here we're making new highs on the day with new highs on the day in delta, so I'm not seeing that divergence. There's a slight divergence today in that the market pushed through highs with a lower high and is pushing lower. But it is something that I pay attention to, but it's not. It's definitely not something I believe or lean on. It's to me, it's much like it's a real time. It's better than a lagging indicator like a moving average or an RSI or CCI or MACD or something. It's better than that for me because it's just telling me what the volume is right now. But the usefulness of the delta in the past has been when you chain a bunch of days together. Like if we look at the delta, so I can't do that now because I'd have to switch the charts and stuff. But if you do an MC, and this is, I'll give you a little nugget here. If you do a microcomposite, because the market has been in balance, okay? So the market's been in balance here for a while. Let's send this microcomposite back so you can see. The market's been in balance for a while. So here it is ping-ponging back and forth from 67 to 26, 26 being the weekly low and the key figure for this week that the market needed to hold to continue its move higher, which it did very successfully. What I would do is take that microcomposite into a separate chart and do a delta that accumulates over time. So you would do accumulate all, and you would see what the delta is doing in that balance and how it's shifting in that balance. In order for me to do that, I'd have to start the chart on this particular day at the pit open and keep it running until the end here, and I'm not going to shift that right now. You'd have to sit and wait for it to reload. But that's a useful thing to look on the bigger picture, and that has less influence of when the pit hours are busy or not, and so on and so forth. You should accumulate delta for months and months and months and share that in the Trader Bytes, but the Trader Bytes became 25 minutes, a half hour long, and the goal was to keep them under 15, 10 minutes is what I'm shooting for. But that's a great way to test delta. Delta is useful, but just understand that it has different influences. Volume is not the same. Volume at the open and in the first hour is not the same quality volume at noon, or 1 o'clock. It just isn't. So the quality is a little different. Mark W., would you discuss the uses of the OS? What sorts of conclusions one can make from its behavior? So Mark, I think I addressed this a little earlier. Rich, would you agree that we kind of talked about this enough?
Yes, and considering the time.
Yes.
Yes.
Cool. Matt, when you see an incomplete auction on close, like yesterday, do you take the overnight trade? I do not, Matt. I do not trade outside of the period that I've studied and I've honed I trade my strengths. I push for my strengths, and my strengths are trading the RTH hours and major pre-market announcements. So I do not hold trades overnight. I prefer to sleep. It's not my thing. So yes, statistically there is something that statistically happens, but I don't know if it'll take out the high and drop or take out the low and rally. It's not my thing, but I'm sure that if I needed to, that's something I can build an edge around. Do you find there's any edge in using Bookmap order delta when BM order delta when stocking entries? I find it difficult using BM for a clear trigger besides the market pausing. near where I'd like to enter. Dash is an example. So let's pull up your example here. Okay, so we have a zipper, a push. Okay. Oh, you're talking, oh, this is not the delta. This is, this column here is the plus minus column. This is simply showing you how much was added or taken away at that particular moment. So what this is saying is, as the market pushed up right here, as the market pushed up, this last print right here, as the market pushed up, bids, there are more bids coming in. This added 13, this added 152, and the inside bid added 1152. That's pretty serious. You don't see that very often. That's what this means, okay? And especially since the bid is only at 294, there's a, if you had the iceberg indicator, the iceberg indicator would be giving you a red number right here, because it's actually the bids. There are more bids that have been added than what's on the offer, which means that there's likely to be an iceberg working right here. And what this is saying here, the 723, this is saying that in the last price change, the last shift up or down of the bid, 723 canceled out of, and you were left with 344. That's what that means. It's useful in a way because I have it up. I have that column up. So right here it's showing that there's some cancellation going on. There's some canceling going on, and the offer is adding. So the bid is canceling, the offer is adding. Over time, I expect this to downtick. This is likely to downtick. Did it just downtick? No. This is likely to downtick. You see how that's building up, building up? Oh, no, it's switched. Here it's building up again. So there's a way to read that. If you're a pure order flow trader, that's a pretty meaningful indication. See how that it ticks up and then it re-adds, ticks up and re-adds. Somebody's trying to work an offer in there. That's all that's saying. It is useful if the order flow is an important thing for you to watch. I think is this the same person? I don't remember. Connor M. How can one be attached to results and emotions and play with the market like a child? So, Connor, we're not trying to play with the market like a child. It's not a, you have to look at the market as a beast, you know, an animal. The best example, went down to Florida with my kids to the Everglades, and we went to one of those alligator shows. And massive alligator, this thing was like 12 feet long, and huge. And I see the market as that. Not in the negative sense, not that it's a scary monster or whatever, but I see it as a very old and very, it has its own flow, it has its own nature, and what you have to do is respect its power, just like you respect the jaws of an alligator. You don't take your eye off of a risk just because you decide that the alligator's just sitting there, he's calm, he's never bitten me before, so I'm just going to go take a nap in the corner and let him do what he wants. You don't do that. So you're not treating the market as if, I don't come in here thinking, oh, the market's this little toy thing in my hands. It is not. You have to give it a lot of respect because it can tear you apart. It can break people down. So what you have to do is actually understand yourself. Just recognize that the market is going to do what it's going to do. It's like the weather. It's going to do what it's going to do. You have no control. You have almost no control on the market. The only control you have is on yourself. And unlike gambling, so the main, I have these conversations with people who aren't in trading who tell me, isn't it like gambling? In gambling, every round stops on its own. Every round has an ending. So if you play roulette, at some point that ball is going to fall on a number and you're either a winner or you're not. You know, black or red, either it hits your number or it doesn't. It stops. You have to actually put in a bigger bet or another bet to continue. Not so with the market. The market is something that just continues and continues. So it requires us to continuously monitor what's going on, and we have to take ourselves out. We have to put ourselves in, we have to take ourselves out. If we don't take ourselves out, then somebody else has to take us out. It's your broker, and that's generally not good news. So in generally, what you want to understand, other than learning the technicals, and again, I would strongly recommend folks watch this video because I cover a lot in there, you know, from just looking at the market holistically to getting down to, you know, the execution part. Just once you have the technical side, you know, most people want to spend you know, 95% of their time looking at the technicals and an edge and a technical analysis and all this stuff. But it's disproportionate. That stuff can, your time is occupied maybe 10, 15, 20% of your training and effort and dedication is on that side. The rest of it is simply self-awareness, understanding yourself. The more you understand yourself as a human being objectively, without the usual lying, and we lie to ourselves a whole lot. We do, all of us do. It's normal. It's how we cope with what we perceive as to be a hostile world, right? We lie to ourselves. This wasn't my fault. They did this. The market did that. I should have done this. I shouldn't have married her. I should have married him or whatever. There's always something outside of ourselves that we have to deal with. Just understand that part of you and understand that the market will see and cut right through it. So the more honest you are with yourself, the more aware of who you are and how you respond to things and what triggers certain responses within you, the better you can apply that 20% that you spend on the technical side. There's a lot out there that is free, that could show an edge, that you can test, that can make money, that does all these wonderful things, but it never comes to light. It never comes to fruition because the person applying it is lacking in emotional awareness, is lacking in discipline, in risk control, in respect for the market. You know, I look at risk for our traders all day long. I have a risk monitor here that sits here, and it's alerting me all day long, and I look at people's responses, and it's just incredible how often people would rather defend a poor trade than to add to a good one. It's incredible. I would say it's 9-to-1 ratio defending poor trades. It's because they cannot accept that this is wrong, and they don't want to put themselves through the process of having to reanalyze and reinitiate another trade, which could result in another loss. They would rather live, it's kind of like that thing we do where we would rather be stuck in a bad relationship that has a few upsides than to turn our lives upside down, move out, recreate ourselves, and then just be in a better relationship, period. You know, as human beings, we tend to give a lot more weight to the former. I'll stick with something that's terrible, but at least I know what it is. I've stuck with this. I'll stick with this trade. I know it stinks, but at least it's a trade that I've taken, and I can see how it happened. You know, just cut it. Just cut it. It's not worth your emotional capital. So I know I'm all over the place with that question, but that's a big thing. Aaron, is scalping off the dome by itself dead? I think you said at one point it is no longer viable due to fee structure, but every picture I see on prop websites paints a different picture. I see nothing but domes and frequently hear the bulk of their traders in scalping, mainly the dome, and using charts very little. I don't know what websites. I don't have a reason to tell you anything that is untrue, and I am experienced. I've been doing this a long time, and I've always done it professionally, either, you know, in Florida or mainly here in Chicago. And I can tell you that it doesn't, I'm not saying that trading off the dome is dead. It isn't dead. There are people who do it. But understand that it's like you showing up to a NASCAR race in a Ford Fiesta, you know. It's just, you don't have as much of an edge. To get an edge, you need you need direct market access. You need a good trading platform. You need a better fee structure, so you need to either lease or own a seat. Think of it this way. Every time someone clicks, the exchange fees alone, every time you get in and out of a trade, the amount of exchange fees that you're paying as a non-member, if I did the same as a member, I think I could take 10 trades. That's the equivalent cost. I'm paying 10% or something as a member, right? So if you're a member, you could scratch a trade 10 times for every single scratch that an online trader. So if you're scalping, you're doing a lot of volume, great for your broker, great for you to experience, actually. It's entering in and out of the market a lot. It has some huge assets. It's my background. It just desensitizes you to the drama of entering and exiting the markets. And it just, you don't have that crazy over analysis with every trade. It just becomes another drop in the bucket, another trade, another. But doing it at retail rates is not a good thing. If you contact Aaron, I think you've contacted us before, or one of our brokers before at Stage 5. And one of the things you can ask for is membership, how you become a member, and so on. And if you want to scalp, that's the path I would be on, and I would make sure that you're using the mobile app as well. I would actually split my account into at least 2 clearing firms. Make sure your connection is solid. There's just a lot that counts, because now you're fighting. Your competition is time-based. All right, and I'm running out of time here. Rob, last question. I'm probably not going to be able to take questions on the that have been submitted through chat. Rob, assuming a trader is able to manage his risk, does success as a professional translate into significantly more winning days than losing days, or is it more win a little one day, lose a little another day, but have a couple of days a month where you have a strong win days that make a month profitable? Rob, you hit it on the head. My experience is the latter. My experience is you generally, as a professional trader, you generally grind. So day in, day out, you grind. You kind of you stay limber, you keep the wheels greased, you come in, and it is worthwhile most of the time. But really what makes your year is a good, strong run. Is a good month, is like August of last year, that sort of thing. So for most traders, you'll find that they come in and they do a respectable thing, they make respectable money, but the goal is to stay disciplined to your losses, because if you don't, and a good run happens and you have lost your discipline just before it, your buying power is terrible, your confidence in yourself is terrible, and it's time that you, when it's time for you to push, you cannot push. So it's just really important to kind of come in, follow your plan. Like one of the guys when I first started trading, he says, look, it's about you coming in, punching in, follow your morning routine, do what you need to do during the day, follow your afternoon routine, punch out, period. Come in. Just commit to doing that. Consistency, consistency, consistency. And what happens is the market, being in the nature that it's in, every once in a while provides that opportunity, in my opinion. Over time, it just provides an opportunity where you can actually see through the market. Kind of like at the end of the Matrix. You kind of start to see through things. I don't know how else to describe it, but that's been my experience. And you cannot do that if you have blown away 70% of your market, if you can't trust your discipline, if you don't have any plans in place, if your routines, and this is a huge one, if your routines are inconsistent, you don't have a routine, again, please watch that video on YouTube that I posted here. Please have a look at it. I really share a lot here. I know it's been watched a lot already. It's about 2 weeks old and has 3,000 hits already, but watch it and I cover some of those routines. I'm really telling you the inside stuff here, but really it's about grinding it out. The business is about grinding, and then in grinding, you get better and better and better. Hopefully, you work out your issues, you remove errors, and then when the time comes, you can push. And you can push because you have the confidence, the plan, the routine, and everything in place to push. It's terrible when you just lose your discipline because you're bored, and then now you're down to a $1,500 account, and there's this huge opportunities that you can take a part in. But guess what? You can't even put a stop on a one lot because the market's too volatile and your account's too diminished. Anyway, that's that. Rich, unless you see something really significant being asked, I think I'm going to taper this down. This is if you need to contact me, I do my best to answer. There are people who will answer for me if it's a question that they can. futurestrader71.com/contact or info@futurestrader71.com. Thanks everyone for listening in and taking the time out of your day to be here. Take care. Talk to you soon.